But we begin with the markets, as we always do here on NYSE Live. Joining me now is Mark Newton. He is the head of technical strategy at Fundstrat. Mark, welcome.
Thanks, Ashley. Great to be here.
All right, so how is the conflict in Iran affecting your investing strategy, if at all?
Well, it's just caused a tremendous amount of cross-asset volatility. I mean, we've seen surges in crude oil along with a big sell-off in the bond market. And, of course, technology has been weak really over the last few months. Huge bifurcation in technology where software has been weak, whereas many of the semis and memory stocks have been higher. Those are now starting to give way. So tech remains a spot to have extreme selectivity with financials also. But there's been really an interesting surge in energy materials to start the year that have actually been pretty encouraging to see other parts of the market, pick up the slack to help technology.
All right, and we're going into the session. Futures are higher ahead of today's session. What has changed compared to the past few days?
Well, what's interesting is the last couple of days we saw a break of the range that had really held since last October. So despite the individual massive amount of volatility we've seen in individual securities, the broader indices have kicked off the year in one of the tightest ranges we've seen in about 40 years. So about a 3% range for the S&P. Very little movement in the indices, but it certainly feels real volatile, right? And so you have a lot of moving parts. My thinking is that the breadth yesterday was about 3-to-1 negative. It was as high as about 12-to-1 negative. That's not a great sign. We still don't really see evidence of capitulation. We heard rumors this morning of Iran trying to reach out to the U.S. to try to cut a deal. I don't know if that's real or not, but at least we have some initial, positive arrows for U.S. equity markets. My thinking is we probably still have more to go on the downside. I can't yet put a peak in crude oil. We're seeing just a massive move to the highest level since last year. That's really going to be key for the markets. My thinking is that we are going to try to figure out a way to end the war, at least from a U.S. perspective, sooner than later. The administration does not want to see crude oil at $80 heading into the summer driving season. Obviously, that can be inflationary. We want to see oil start to pull back pretty rapidly. That can't happen if there's any sort of prolonged war. So my thinking is it's going to be, at least there'll be evidence of this being over, hopefully within the next couple of weeks.
All right, and you mentioned a key area of focus, of course, this week is oil. How are you approaching this as well as the overall energy sector?
Well, what's interesting is in the last couple of days, we've seen oil stocks really diverge from crude oil itself, which is interesting. Normally, when that happens, it means you could be approaching a potential peak in the commodity. We saw that also recently with gold stocks starting to pull back a little bit while gold itself has been strong. So, after this past weekend when the strikes happened, Exxon has actually been down from that level, which is really fascinating because crude has been up about 15% in the last few days. So, my thinking is most of the sector has gotten dramatically overbought. And if anything, I don't sense that it's going to be able to continue on the same trajectory in the months to come. I actually think, within the next few weeks, we'll see evidence of energy peaking and starting to consolidate a bit. And it might be wise to take a look at software, of course. That's been stabilizing quite nicely and is actually, yesterday we saw nice gains in software while the rest of the market was down. So, it's going to be right to look for mean reversion in some of the sectors which have been hardest hit, and part of that is technology. Very, very difficult still to say we're going to buy the Mag 7 and think they're going to push back to highs, and I think you have to be selective there, but still a lot of parts of the market working with regards to emerging markets. Just looking at industrials, looking at materials and energy, we need to get technology and financials working again, though that's 40% of the S&P. Difficult to see a move straight back to new highs unless technology can start to work a little better.
How are you advising your clients to navigate the volatility brought on by what's happening in the Middle East?
Well, I think that the biggest message for 2026 is diversification. I think investors still remain way too overweight technology stocks that obviously dominate our indices and most ETFs. So most people that own SPY or QQQ have just a substantial amount of money in technology, and that's really been underperforming. So it's proper, to look for other areas outside of tech and really consider things like the equal-weighted S&P. The ETF is RSP from Invesco. That might make more sense this year than looking at SPY, just based on owning more energy, owning more materials, owning more industrials, versus just a solid tech bias. So diversification is key. Keep your bets small. We're still in an incredibly volatile time. I don't sense that ends right away. Even if we rally back to new highs into April, which is a possibility, we're still shaping up for a very volatile year, I think, which is not going to be easy for bulls or bears alike.
All right, and while Iran is the headline this week, investors are also going to be focusing on the February jobs report, which is due on Friday. What are you anticipating?
Look, I think the economic data has been, pleasantly surprising to the upside in recent months. I think this really makes the Fed's job very, very difficult. We know that Warsh coming in, the administration is going to be jawboning the Fed to cut rates, but the economic data has been pretty solid. If anything, the PCE data that comes in the middle part of March probably is going to be much hotter than expected if the readings from the ISM were any gauge. So rates have been, pushing higher. On the long end, we see crude oil now at 80. That makes for a contentious relationship for any new Fed leader to kick things off. The amount of Fed rate cuts have actually dropped from it was about 2.5 cuts. Now it's down to about 1.5, specifically given not only crude, which could be inflationary, but also the fact that economic data has been much better than expected.
All right, any other storylines you're looking at that might be flying under the radar right now?
Look, I think it's just important to realize that this is a midterm election year, and it often is a lot more difficult than people think. We're in the second year of the second term of the presidency, the sixth year. If you look back through Truman, Eisenhower, Nixon, Reagan, Bush, Obama, Clinton, we've had a very difficult time when we get to the sixth year, which is this year. So investors can't just anticipate that this is a geopolitical event. It's going to be up, and away. The cycles honestly still point to weakness at some point for 2026. Some in the spring and likely some in the third quarter. So it's going to pay to be, keep the powder dry and wait for opportunity. Treat it much more as a trading market than an investing market, at least for this year.
All right, Mark Newton, head of technical strategy at Fundstrat. Thank you so much for
Thanks,
joining us at the New York Stock Exchange.